Hello, everyone. Thank you for joining today's session on mortgage. Um, through Kolkata-Days info session initiative, we are trying to share knowledge within the Kolkata-Days community. And today we have few individuals with us who are in the mortgage sector, who are directly working in the mortgage sector. And we would like to gain some knowledge from them. If you have, if you are thinking of buying a property or thinking of selling one or thinking of getting an investment property or just have any questions around mortgage, please feel free to ask questions. The way we have scheduled this session is at the very beginning, um, I have a few questions for the speakers. And then as we move ahead, we will open it up for everybody and anybody can ask questions. First of all, I would like to introduce each of the speakers. We have three speakers with us. One of them may or may not join us, but I'll still go ahead and introduce all three of them. Firstly, we have Dipankar Banerjee. You can see him wearing a blue shirt. So Dipankar Banerjee is a home finance advisor with Scotiabank. Thank you for joining us, Dipankar.
Thank you very much for giving me the opportunity.
Thank you. We also have Devdut Das with us. So Devdut Das is a mortgage agent at Dominion Lending Center. So Devdut Das, thank you for joining us.
My pleasure. Always welcome.
Our third speaker is Kaushik Gangopadhyay. He is a mortgage specialist at BMO Bank. He may or may not join us. There was an emergency and he had to go somewhere. So he said he will try to join over phone. So we'll see if he's able to join, but we will continue the session. Before we go ahead with the session, I would like to place a disclaimer for everyone. Although we have few individuals from the mortgage sector, they have only agreed to attend as a friendly gesture and to share their knowledge. Any advice that is given in this session, I would request you all to do your own due diligence and research before you take any mortgage decisions. That way, you won't have any issues. At the same time, in case anybody does get into any issues after following any advice in this session, I would just like to say that Kolkata-Days or its admin or moderators or the speakers in the session or any participants would not be held responsible for it. So with that, I would like to start today's session. So today's session is a generic session on mortgage. We will discuss on many different topics within mortgage. So firstly, I would like to ask a question to Dipankar. So Dipankar, how does a home finance advisor help?
Can you be specific, home finance?
So rather than a person going to the bank directly, why would a person go to a home finance advisor?
Okay. So if he goes direct to the bank, direct to the Scotiabank branch, it's may possible also they will not able to offer you all the products which Scotiabank has, which we have. Most and more. Apart from that, there is some discretionary level rate we can apply. We can give the discretionary level rate level that we can do. That is the advantage of the customer of the benefit. Plus, apart from that, there is a some advice which you can give, but for getting that, you have to go to different portion of the bank, different thing, book an appointment or something like that, which we can freely advise.
Okay, all right, thank you. My next question is for Devduta. So Devduta, you are an independent agent. So you're not directly associated with any bank. So what is the advantage of working with an independent agent?
Okay, good evening, everyone. Independent mortgage advisor or agent is not been related to any particular financial institution or any banks. So he has the leverage to help the clients or customer who approaches him to the wide variety of financial institution available in this country. So let's say there are almost 65 to 70 A lenders where all the products also been available. So we as an independent can guide that particular client and customer, saying that, okay, for your profile or whatever your income is and whatever your credit score is, I think that particular bank or financial institution will suit you. So instead of bogging him down to one particular financial institution, we can give him a range of financial and see which suits him.
Thank you so much. So one question. So I'll ask this question to Dipankar Da, and maybe if you have anything to add, Devduta, you can add. So my question is, when should we approach an agent? Like when we are thinking of buying, at that time, at what stage should we approach an agent? Is it a few months before we decide to buy, or I mean, a few months before we decide a property, or during, or when we are looking at a property, or after we have finalized the property? Dipankar Da.
I should say after you finalize the property, because if you, let's say you are getting a pre-approval qualified, but in the reality, there is no pre-approval. Like for an example, you are pre-approved based on certain criteria, your job and all these things, your current day situation. You are closing the property after 3 months. After 3 months, your condition may change. That time it will be a problem for you to qualify. So basically, once your condition of finance is done, which is called COF, a form, there is a form of you should go ahead with for the mortgage thing.
Okay. Devduta, would you like to add?
I should just like to add it, like in a sense, when a person decides that, okay, I think I should start looking for a property, I have certain income, and at that moment he doesn't know how much he will actually qualify for, and what can be his amount of mortgage he can get, and what he knows that, okay, I will put this much down payment. So that might be 5%, everyone knows is a minimum down payment. And then that's an amount he knows, but he doesn't know exactly how much he will really qualify for that. In that case, it's better to ask an agent or something to approach him and say, okay, this is how my finances are. Can you help me knowing what will be my exactly not to get a pre-approval, but at least to understand what maximum limit I can go to purchase my property. In that sense, he can make an informed decision. Okay, if I can go for a 700,000 property, I can go for a 900,000 property. So he knows now where his range is. Then he can now keep looking for a realtor, buy the property, and then he decides whether he should go to a bank directly, because now he knows what is his range. But that won't change. Mostly won't change, but in the circumstances, yes. Because if you decide today and then you drag in for 6 months, 1 year, situation will change, because the bank's rates are changing, qualifying rates are changing, this keeps on changing. But of course, I say that on the first step is at least first you approach and try to know what is the amount you can qualify for, so that you don't have that problem later, understanding that once you buy a property, then you stand in a fix that, oh, the bank is not giving me this much mortgage. So, yeah.
Okay, so we had uh, two different opinions. So I'll just try to add here. I think what Debuta is saying is correct from the perspective that first, when when you're thinking of buying a house, first you need to understand how much you can afford. So I
Right.
think we
Your
meet with the
affordability.
agent and we first understand that. And then I think what Dipankar Da was stressing on was the rate that you get that will only get finalized on an actual property. Like when you get an actual property, when you finalize a property, and then at that time they do the final paperwork, that is when the actual rate gets finalized. So even if you get a pre-approval rate earlier, it may or may not apply when you're actually purchasing. So that is what I understood from both of you. Um,
Indrajit, with the help of the Google and internet, everybody, I think those who are going to go for a purchase of their biggest purchase in their lifetime, they already do some research and then come to the market,
okay,
right? And with the help of the Google and internet, more or less 50% or 60% people know how much their affordability,
okay,
because there is a lot of Google all these things. So they
okay,
not exact the dollar amount, but they know at a ballpark what is their
okay,
affordability.
okay. Yeah, definitely. So nowadays there are many tools available. We can also find that out. Okay. So now I have a question from one of the Jonagon. So how much of a down payment is needed? So this question, I'll first ask Devduta. And then Dipankar, I think this is a generic question, not much to add, but if you want to add anything after that, you can add. So how much of a down payment is needed, Devduta?
Oh, okay. So like if you are a first-time home buyer, you're looking for a property, so minimum 5% is a down payment, but that limits up to 500,000. So beyond, if your property value goes beyond 500,000, so the differential between 500 to the value of property, it should be 10%. So roughly around, let's say, property beyond um, 500,000, 6 to 7% should be the minimum down payment on an average. So that's always called a high ratio mortgage. So, yeah.
And what if it goes beyond 1 million?
So beyond 1 million, then it becomes you have to make a, what do you call it? It becomes a conventional mortgage, which is that you have to make a 20% down payment, and then you qualify for that.
Okay, and then is there any other limit beyond 1 million?
There is actually, there was a sliding scale before. I don't know, Dipankar might be able to say that. Is there still a sliding scale, Dipankar,
Yes,
beyond 1
yes,
million?
Yes.
Yes.
So
Okay.
that's why I'm telling it. The question Indrajit you put in front of us, there is a lot of variables included on that.
Right.
First of all, what Devdu said is the sliding scale. So sliding scale is the main portion. First thing. Second thing is your situation. If you are coming just now yesterday in the country, and if you want to buy, there is a 35% down payment for the, you don't have any job, you don't have anything, but there is certain criteria for the newcomer. There is a program also. It's not that you cannot buy, you came yesterday, you cannot buy it today. So there is a possibility. So it depends on a lot of variability. It's not one thing.
Okay, so you're saying that even if you arrived recently and you are not a PR.
Recently means I'm telling you, if you arrived with a PR yesterday, you can get a buy house also. Yes.
Okay.
Yeah, in those
but
cases.
Are you saying the down payment would be more?
Yes. In those cases, like you have to pay almost 35% down, and then I think
no, there is a even less than 35% also possible, but there is a different program like called a straight right program, or
Right.
newcomer program. There is a lot of
Right. So
program is there.
every financial institution or banks will have a
Exactly,
different
yes.
program for that. But like for a generic term, like a person who comes, most of them doesn't bring a lot of money. So bringing 35% minimum is huge money. So usually the person who comes here or salaried person get the PR, he takes little times to get his job. He has to build his credit score. So all these factors keeps on counting. So after a year or so, he has built up his credit score. Now he can approach the bank. He got his job. You need to be in the job for 3 months. So
Okay.
and it should be a permanent job. So those are the different criteria which every financial institution or bank sets up. But yes, on the ballpark, yes, 5% sliding scale, and beyond 500,000, 10% should be the minimum down payment needed.
Okay. In terms of the rate, interest rate that is charged, does it differ if, like, let's say there are two individuals and they have the same profile, but one person is applying for the first home and another person is applying for investment property. So does the rate differ?
Yes.
Asking me?
Yes, Dipankar.
Oh,
Okay. So it's differ for the different financial institution. Like my TD bank doesn't depreciate investment property as per their 4 or 5 property investment property or primary principal residence or whatever it is. But Scotiabank does. So it depends again. For an example, I'll clarify more. I just did one deal yesterday for an investment property. The rate I put at the rate, it's a little bit higher than the normal principal residence rate. But TD, it was not there. So I'm just giving an example.
Okay.
Idea.
So it depends from bank to bank?
Exactly. Depends from bank to bank. Yes.
Okay.
but yeah, I'll add a little bit of what Dipankar said. Yes, there will be one or two which will not basically not make a differentiation, but most of them will make a differentiation between your first time home buying and then your investment property.
Okay. Now what I have a few more questions. But what I'll do is I'll also open it up for the audience, and we will just alternately ask questions. So I see Madhuchanda has a question. So Madhuchanda, can you ask this question? Ask your question. This is for Devdutta.
Okay. Hello. So my question is, you said something about credit score. So if a person's credit score is excellent, say the highest category, and they go for a mortgage rate, will that affect the rate that they get from the bank compared to a person who has an average credit score?
Yes, yes, a person having a better credit score gets a little leverage more when he applies for a mortgage. And the person which doesn't have that's why they have a certain guidelines of credit score that they say beyond 680 should be the credit score to get a better rate. But then a person with 680 and the person with 800, of course there will be a little difference. It might not be a much difference, but then still they will give a little difference because of his better credit score. But below 680, the rate will also be different. So I'm just giving an example. Yeah.
Can I add something?
Sure.
Actually, yeah, credit score is the thing, but it's not the only the score, because when we look into the credit report, it's not in the score. Because just for an example, I have done credit score of 575 also. I have done the mortgage. I couldn't do the 770 also. It depends how you utilizing your credit. We analyze that, not only the credit score.
Yeah, true. Yes, I get it.
I did not understand that. How do you utilize your credit score, meaning?
So one question,
Score.
Dipankar, how can a person, can you give an example of a scenario where a person is utilizing credit properly, but at the same time has a lower credit score?
Okay, fine. Yeah, utilizing it properly. But let's say, for in my case, it was there's a lot of mispayment for its utilizing. It was utilizing, okay, fine, fantastic. But there's a lot of mispayment. It was a R3. So you have to be careful. You shouldn't miss any of the credit card payment or any credit product. Don't do that. Never do that. Any of your credit product. So it's basically utilizing how you are managing your credit. Basically, we see better term is managing the credit. That's all.
Yeah, there is
Okay.
another thumb rule for credit card to get a better credit score is don't utilize your credit limit. Like let's say you have a credit limit of 10,000. Let's say your card has a limit. So don't every month, don't try to spend 6,000-7,000 and you are paying it every month. You are utilizing, you are paying, but your credit utilization is much higher. So thumb rule is don't try to go beyond 30-35% of your credit limit. So that also enhance your credit score. Those are like few of the criterias which needs to be followed
Yeah,
to enhance your credit score.
it's follow on the credit card portion. Yes.
Yeah.
Absolutely.
Thank you.
Thank
you,
you.
Madhuchanda. Do you have any other questions, Madhuchanda?
I have one, but it's a little a different topic. So yeah,
Okay,
let's.
we'll come
Yeah.
to it. Okay. So I have a question, but before that, just checking, does anybody else have a question? Okay. Somebody was saying something. Aniket.
Yeah, I have a question. Like I recently switched, like changed a job. So will that make me like not applicable to ask for a loan, or like
Yeah,
how
that's
does
a
it work?
good question. So this is for Dipankar.
Absolutely no. Because so far we can prove your employability. It's possible. It doesn't make any difference. People can switch their job. That's their legitimate right.
Okay. So, but like, do I need to provide, like, I don't have a P slip because I just recently changed.
Okay, let me give you an example. Throw you an example. You used to work, let's say, $70 an hour. From there, for your different situation, you just started $30 an hour. Obviously, it will make your difference. But if that is not remarkable difference, so what's the problem?
Okay.
Okay.
Thank you.
Okay.
Because changing a job, you have a legitimate right to change the job at any point of time.
Okay.
So that doesn't mean that you will not be able to borrow the money from the system.
Okay.
Devduta, would you like to add anything?
I just like what I feel is like working with different financial institutions. Like let's say you are in IT, you are working in IT, that's not a problem. Suppose you switch to some other your skill, or so then they might like to see that you work there 3 months, then come to us. It's not a long, just wait 3 months and then you come to that. But if you're in the same industry, you keep on switching job, it's not a problem.
Okay. Thank you.
But I will add one more thing on that. 3 months, we see why we see 3 months, because 3 months is the general. It generally says it's a provision period, because that before that also your employability also not completed, confirmed. So without the confirmed employability, we cannot grant you the loan, right? So
makes sense,
that's
yeah.
why it's 3 months. You confirm your employability.
So I think when the person is applying, sometimes I have seen that the mortgage broker asks for a letter, employment letter, which states that you are a permanent employee.
What happens is that a letter of employment will actually that whether you are a permanent employee or in provision, they write. So the moment if they write, being from HR, you will get the letter. So they will write whatever your condition. You might come and say, no, I'm okay. I'm working there. But then HR letter, that letter of employment might say provision. So the moment the word provision will be used, so then there will be a hitch. So if there nothing is written there, anything is a permanent employee, maybe he's joining yesterday only, but they write permanent employee. So it's not a problem.
Okay. So next, I have a question. What do you need from an applicant to give a rate, to give out a rate? Like when the applicant is first approaching you, what basic information should the applicant bring with him? Maybe we'll start with Devdutta.
Usually when an applicant or any customer approaches, we ask whether he is like he's working or he's self-employed. That's first the category you can divide that person. And if he's employed, then we'll ask to provide his salary slips. Yeah, salary slips, and with the salary slips, then like how much will be his down payment and all this. So in that way, you can always like make a calculation of his eligibility and then see and ask him whether he is employed, whether he has any debt. That those are few questions you need to ask, that whether you have any debt, if you have any, do you have a car loan? So what is that amount of that car loan? So that when you calculate his eligibility, you can make a rough ballpark, but it will be almost like whatever he will be qualifying for. So if it is employed, then pay slip, pay stub, they call it pay stub here. Latest to pay stub is a basic document needed. Then we ask for other documents like your return, tax return you filed last year, your T4 and all this. So yeah.
I will ask rather Indrajit one more thing. First, I will ask the client or other applicant whether he is eligible to borrow or not. If a person is in a not PR status, not eligible to buy, there is a no use of that. Got my point? So what is the status of the applicant? Whether it's a student, whether it's a PR, whether it's a citizen. Because if a person, let's say, even if in the passport also, PR also, but he last 6 years, he didn't stay in Canada. Maybe he stayed in Middle East. He doesn't have any tie. He is not filing his taxes also regularly basis because he is not earning anything. So we cannot establish any tie in Canada. We will not be able to give the mortgage to that person.
Okay.
Employment comes afterwards. But first, what is his status?
Okay. One question, Dipankar.
So in continuation with that, Indrajit, sorry to bother. In continuation to that, when you say status, is like the status of the confirmation of permanent residence or the COPR is fine, or you need the actual physical PR card to check that?
Now, COPR, I have done the COPR. COPR is, but is there any part? Yeah, actually, a PR card is actual. There is the temporary PR card. Yeah, also is possible. Like, number is different. I don't have any idea regarding the PR immigration thing, but I have done where they gave a temporary PR.
Okay.
What is this called? Right.
No, that temporary PR is a COPR because nowadays PR cards are almost taking 8 months to come, so it's quite a long time. So yeah.
Basically, we have to establish that where the person is eligible to make a tie in Canada, make a status in Canada, that either PR, permanent resident. If it is a PR, then within 3 months he will get the PR. Obviously, why not? He will get the PR, and he has to prove that. Obviously, that.
Okay.
Okay. One more question on the same topic. A person who doesn't have a PR, that I was under the impression that the person can still buy, but the person will have to pay more. I think there's a 15% or some interest that the person has to pay. So can
even
you
15%? Yeah, that is there. But even if you are buying in the golden shoe horse, also there is certain area is called golden shoe horse. If you will pay that, you pay extra 15% also. But that 15%, if you pay extra as a foreign buyer, but within 1 year, if you produce your PR, you get the credit of that.
Oh,
get refunded that.
Okay. All right. Thank you. Next question. I see that a question is there from Shomdatta. Shomdatta, could you please ask your question?
Sure. Thanks, Indrajit. I would like to know, like, what would be the impact on my mortgage, like if I go for a loan from a lender versus a B lender, if at all, like, I mean, if there such term exists, because we came across those terms, a lender and B lender, when we went for the mortgage.
Labdul, you want to go first?
Yeah, see, most of the financial institution or banks are all A lenders. So apart from those big five, there are another at least minimum 50 to 60 financial institution. They call mortgage finance companies. So they are all A lenders. A lenders means those who can give you up to your 95% of your mortgage. So yeah. So when it comes to a B lender, that's a different category altogether. B lenders is the person who doesn't qualify under the A category. It means maybe his credit score is bad, or he has let's say he was a bankruptcy file of then he came after 2 years to do that. So those are the one which A category of lenders won't lend. Those are the ones goes to B lenders, and the moment you move on to B lenders, automatically your down payment will be on the higher side. So there you cannot give 5% or 8%, and there will be no high ratio mortgage. All will be conventional. So I have to make minimum 20%. You have to make a down payment in that category, and the other parties, your interest rate also will be on the higher side compared to those A lenders and A category lenders. Dipankar, you want to add something?
Yeah, exactly, absolutely. There is a lender for the 5 banks which is existing, and not 5, basically 6 banks. The main advantage of that going that bank, because if you have other things are catered, like for an example, your credit card, your short-term loan, your car loan, that is not covered by the B lender. They cannot cater that part of that. But your B lender, if you are a customer of, let's say, TD Bank or BMO or something, they will take care of your all your financial needs, which B lender cannot do that.
Thank you. My questions are answered.
And is the rate different? Rate of
Yes.
interest?
Yes.
You have to pay higher
Yes.
rate.
Okay.
Because generally B lender offered the mortgage on a posted rate. Let's give an example. For a 3 years fixed, I can offer 6%, but their rate is 6.5.
Okay.
It all depends. But I can go a little bit of prime plus little bit of discretionary level also, if the customers other things are very lucrative.
Okay. All right. Thank you. I see that Kaushikda has joined us. Kaushikda, thank you for joining. So Kaushik Gangopadhyay is a mortgage specialist with BMO Bank. Kaushikda, can you hear us?
I think he's mute.
Kaushikda, you might be on mute.
Okay, sorry. Can you hear me now?
Yes.
Okay.
Kaushikda, good evening.
Good evening.
Good evening, Kaushikda.
Good evening, Dedu.
So Kaushikda, we already covered a few questions. We are still going ahead. There are still quite a few questions left. And right now, this is an open session where I also have a fixed set of questions that I'm asking. At the same time, we are open to any questions from the participants. So already Devduta and Dipankar had answered quite a few questions. I have a question for you. So maybe if you could answer that. Can you tell us the difference between a fixed and a variable mortgage?
So the fixed rate and variable rate mortgages are very distinctly different. So fixed rate means you get a rate which is fixed for certain periods, so 3 years, 2 years, or 5 years. It doesn't change.
Okay.
Regardless whether the prime rate is going up, government decision is changing, So it's a fixed rate. You are good to go. Like last year, prime has been raised by 7 times. And those who had a fixed rate prior to that, they have been enjoying. They don't care.
Yeah.
So that's the fixed rate. Variable rate is with the prime rate. Generally, the banks give you a discount on prime. It may be prime minus 0.6, prime minus 1, prime minus 0.9. So when the prime goes up, obviously it goes up because the discount portion is fixed for the term. Only the discount portion is fixed, not the interest as a whole.
Okay.
So once the things goes up and down, and accordingly the interest rate goes up, and your mortgage installment may go up and down.
Okay. Thank you, Kaushik. Another question on the same topic. When do we select a fixed versus mortgage? How to take that decision?
So it's a very tricky question. I mean, I don't think there is a very clear answer to it. Nobody had imagined that this is how the interest rates will go up. We all knew that interest rates are going to go up, but to what extent? That idea no one had. Now, normally in a scenario when interest rates are low, the discounts were high and prime was low, at that point of time, fixed rates were not lucrative. Those were high rates.
Yeah.
And no one would like to go for that. But once the rate goes up, inflation is up, then obviously the fixed rate paid better. So it's a very tricky question. So you really don't have a very clear answer when to go with fixed, when to. But when you see the overall inflation is on the lower side, it may be assumed that there is a very bleak possibility of interest rates going up.
Okay.
If the inflation is very high, be sure today or tomorrow the interest rates are going to go up. So that can be one of the parameters someone can use when taking a decision on fixed or variable.
Okay, thank you,
I will add one more thing.
Sure.
There is a lot of other, apart from the question that told me that's a macroeconomic thing, inflation. There's the other also socio-economic thing to also involve. So you are the best person to judge what is your capacity, risk capacity on your financial situation. So you have to judge accordingly.
Yes.
And on the same note, Dipankar, one more thing came to my mind. I must highlight that when it's a rental property, it is always recommended people should go for variable, because in the rental property, there is every possibility it's an investment and you are going to sell it at any point of time. Because if you are with a fixed rate, then your penalty will be much higher. If you are with a variable rate, you are going to end up only with 3 months of interest. So that is one very thumb rule, that for the investment properties, people should go with the variable rate, even though rates are higher.
Absolutely. But if it is a shorter period of time, let's say 1 year, and if we can afford it with their cash flow situation, I think 1 or 2 years can be think on that also.
Yeah. I mean, it all depends on the situational intricacy. That is absolutely different. But case to case, time to time, things will vary. But this is kind of a thumb rule for the investment property.
Absolutely, yes.
Okay.
Absolutely.
Okay, thank you. We'll move on to the next question. So Madhuchanda has a question. Madhuchanda, can you please ask your question, and maybe Devdutta, you can try answering that first.
Yeah. Okay. So my question is, say I buy a property, say from 2-3 months from now. Right now the interest rates are very high, so I decide to go with variable. But say next year, and I choose that for 5-year term, like variable. But say next year or 2 years down the line, the interest rates are coming down and the fixed is also coming down, the fixed rate. So what kind of penalty will I have to pay if I want to switch from variable to fixed? And will that make sense? Like, even if the rate of interest goes considerably down, so uh, like either or, like if it is from fixed to variable or variable to fixed, like the switch, how much, what kind of penalty does one have to pay?
Usually, most of the financial institution and banks, if you switch from variable to fixed, there usually there is no penalty from variable to fixed, but you can't do the opposite. You can't go the vice versa. Like if you are having a fixed interest rate and you want to switch back to variable, that won't be possible. And if possible also, then the penalty is very high. So, but usually when you have a variable rate, so let's say currently you have a variable rate, and then as variable rates are going up, so you want to move to switch. So they allow you to move to the switch, whatever rates existing at that point of time, they will offer you that this is other fixed. You can always get into a fixed interest rate. So there won't be any penalty usually.
Okay.
Kaushikda, am I right?
Yeah, absolutely.
Yeah.
So, but so in case you said from fixed to variable, that will never be allowed. So even like
Yeah.
like if my fixed is 5-year term and
Right.
after the end of that I can move to variable, right?
Oh yeah, after end of the term you can do whatever you want to. You can switch, you can change, but within the term you cannot switch.
You cannot switch, or is it too costly?
Like if you want to break, see, you always can break, and you want to move it to some other institution, you can do that. But then the penalty of fixed is very high. So like you have to pay 3 months differential of that. Whereas if when you are in variable, you always have that option. You can also getting a better rate somewhere. You can always also switch. Where there is only you have to pay 3 months interest. You just need to judge whether paying that 3-month interest and moving to some other place is like you have to do a cost benefit analysis on that. Yeah.
The breaking is called IRD, interest rate
Yeah,
differential.
interest rate differential, IRD.
There's a lot of calculation involved on that.
Yeah.
Okay, thank you.
So I think Shanda has a question. Shanda, would you like to ask your question?
Sure. I want to ask Mr. Kaushik that, he made the good recommendation that for investment properties, it's better to have variable interest rates over fixed. We agree with that. But now with the interest portion of the mortgage payment being higher, given the increased interest rates, maybe it is a blessing in disguise that you can write off or claim in your taxes the interest portion of the mortgage payments in an investment property. Do you agree with this approach or tactic? Your take or your expert opinion on this, please.
So, investment properties, see, there are different tactics. Firstly, who is your lender? If the lender has a policy that they're going to change the installment or the mortgage amount based on the change in the interest, they are recalculating the amortization every time and changing the amount to be taken on a monthly basis. So then basically you are not doing, you have to pay the extra amount, and you can't come out of the things, and you keep paying, and your equity is also being paid and interest is also being paid. Otherwise, what happens? From your installments, first, the interests are taken out. At one point of time, when your total installment is gone for the whole amount is gone for the interest, basically that's kind of a trigger point. So after that, if it goes further up, negative interests accumulate. So if that kind of, unless the trigger rate is reached, if you keep paying the interest only, I would say it's not a wrong strategy. Just ride the wave of interest, high interest, and then at the end of the term, if you still have the original amount of mortgage, the loan amount, it's still good because it's an investment property. You are depending on the appreciation of the value. But in case you see you have reached the trigger rate, so now the negative interest is accumulating on the principal. So at the end of the term, you will see probably you started with a 600,000 mortgage and you are ending up with 630,000. That is not right. So in that case, I always recommend voluntarily increase the payment so that your original loan amount doesn't go further up. This is a strategy I recommend if your lender is not automatically adjusting the mortgage amount. Like in BMO, it doesn't automatically adjust the mortgage amount. It keeps it same in the hand of the borrower, and it's borrower's responsibility to increase it on their own. So this is a good strategy in a scenario like that, when you have the control on paying the principal and the interest.
Kaushik, can I add one more thing with your permission?
No, please go ahead. You don't need permission.
It's a very good strategy in case of holdco, because a holding company, then it's a corporation, then it's a different, you can deduct all the tax in the corporation. So then it will be very good, very good game in case it's of taxation. But provided if it's a holdco.
This strategy is not good for principal residence or a property where you are living, but for the investments properties or holdco, it's always good.
So one question around the same topic. You mentioned that we should never let the outstanding balance go above what we originally had taken the mortgage on. But what if the amortization keeps increasing? Let's say earlier my amortization at the time of loan was 30 years, but now let's say the outstanding balance hasn't increased, but I'm paying, let's say, around $100 only towards premium. So my amortization has increased to 50 or 60 years. How should we handle that?
Yes. So amortization, obviously, if your balance is remaining same, obviously the same amortization doesn't work out. But at the end of the term, that's the beauty of our mortgage system in Canada. At the end of the term, you can just do a refinance. It's not going to change the amount, but you can restart a 30 years amortization or 25 years amortization based on your scenario.
Okay, thank you. On a similar topic, there was a question by Shayan Ghosh. So, and I would like Devdutta to answer that question. So, Shayan, can you ask your question? Shayan, can you ask your question, please?
Sorry, I was just on mute. Yeah, I have the question that what is exactly mean by a trigger rate? And if my payment is less than, payment is less than the monthly interest, and what are the consequences? And how we should avoid those consequences?
Yeah, okay. Basically the trigger rate actually this year, most of the people who have taken the loan around 2021 has hit the trigger. I'm talking about the variable rates. Is the rate at the point where your amortization go negative? You might be paying a monthly amortization, or let's say in our terminology, that's a 1,500, which has a principal and interest portion component inside it. Now, Bank of Canada, that will happen only for the variable. The fixed rate doesn't come into the picture on this trigger rate. So it's only for the variable cases. Now, Bank of Canada keeps on changing the interest rates. So it's going on the higher side. So the moment if it comes what will happen is initially when you have taken the loan, it might be almost, let's say 55, 45 principal and interest. Now a point came where it is now the whole amount of your amortization is not even covering the interest. So that's the point, that's the time when your trigger rate has been hit. So basically we what we do is we usually suggest that the moment you shouldn't bring it to this point, that where your amortization goes negative, try to add some more payment to your amortization, so that your trigger rate goes further away, or else as Indrajit said, it happens for people where they have taken amortization of 30 years, but when they started checking and they see that their amortization is now their total period is now for 45 years, 50 years. So the period of 30 years has not extended to 50 years. It is just the point they're waiting for the terms to end, when they will come up to you, send you letters saying that make adjustment to this amortization which you are paying every month.
So making like which one, if I have some extra money in my hand, what is the suggested way? Making a prepayment or increase the monthly payment? Which one is better?
Well, in that case, it depends on the scenario where you are stuck. So if you can make a calculation sitting, let's say, you're saying something?
No.
Oh,
not from my
okay.
side.
So you can make a calculation, like say with the lenders, whoever. So, okay, if I increase another, let's say $300 per month, will that help me? Or should I make a lump sum payment? Will that help me? So there will be actually there is a complex calculation. Every lender has a separate calculation for that. So in that case, let's say maybe making additional $300 has pushed your trigger rate further to another 1%. So for now, you are okay. You might be okay doing that also. So that's how it should be calculated.
So I think so if we do a down payment, so that directly goes towards our principal. So our outstanding balance goes down.
Right.
And but although it all depends on how much prepayment we are making. If we are just paying around 10,000 or 20,000, that may not really have a huge impact.
Yeah.
Indrajit, I can say one thing. Kaushik already answered that question, because just now he said that after end of that your term, whatever it is, that 3 years, for 2 years, 5 years, your amortization is again going to 25 or 30 years.
Yeah.
So basically now you have to decide whether what is beneficial for you.
Because if let's say I don't do a prepayment and I increase my monthly payment, and with the current rate of interest, at least 90% of that down payment amount that I've allocated, that will go to the bank. But whereas if I do the prepayment, the entire amount goes to my principal. So my outstanding balance comes down. So shouldn't that be a factor in our decision?
Can I take a moment to explain this to you, Indrajit?
Sure, go ahead.
Okay, so basically, whether you want to make a lump sum payment or you want to increase your monthly payment, in a normal scenario, when the interest rates are not going up or anything, suppose your monthly payment was $1,500, you made it $1,800, $300 was straight away going to principal. You make a lump sum payment, $3,000, it straight away goes to your principal.
Yeah.
But in a scenario like that, when the interest rates have already gone up, so system automatically is doing its calculation in the background.
Yeah.
For every lender, they have a amortization calculator. It's automatically doing the calculations and how much interest should come, how much principal should go. So they are doing that. Now, when you increase the payment, if your interest has gone up more than the payment that you are increasing, or it is equal to that, it will first go to interest. You make a lump sum payment, then it calculates how much amortization will be adjusted. Is it good enough after adjusting the additional interests to go to principal? Then only it will go to the principal. Otherwise not. Regardless, it's lump sum or monthly increase, it is always going to go to the interest first if the interest amount has gone up.
I have done a prepayment and I had a different observation. Yeah, because whatever. Oh, like let's say as an example, let's say my monthly is $1,000, and in that the interest component is, let's say, $900, just as an example. And let's say I make a down payment of 5,000. So what I saw that the 5,000 went directly to the principal. It was deducted from the principal. And then
it might have happened when the monthly payment that you are making, that was still covering the interest.
yes,
And still it was like, say you are doing $2,000 payment on a monthly basis, right?
Yeah.
Out of that, say 900 was going to principal, 1100 was going to interest. Now interest rate has gone up. So what happened? Now 1300 is going to interest, 700 is going to principal. So you are still in a scenario when your interest is covered by your monthly payment.
Okay, understood.
Now you give a 5,000 payment, it will straight away go to your principal. But
understood.
when the scenario is your entire $2,000 is going to interest,
yeah.
rather 2,200 it has become. So then that $200 accumulated for how many months? That will be paid.
Okay, understood. Yeah, that makes sense. Because I had a similar situation where my outstanding actually increased because the interest became more than the monthly payment.
Right.
So yeah, I completely agree with that. So Shayon, are you satisfied with the answer, or do you have any other questions?
Yeah, like if I increase the payment now, what are the situations when bank will allow me to decrease the payment once again? Like if the interest rate goes down, how bank will decide that I'm good to reduce the payments then?
So when the interest rate goes down, if the amortization in the background calculation comes down to the level that you are less than the expected amortization period, then probably banks, I mean, still again, it bank to bank policy varies, but BMO does allow you in a scenario like that.
Okay.
So basically you had a 30 years amortization. Interest rate has come down to a scenario where your expected interest rate amortization was 28 years, but you are at so much of interest rate has gone down that your expected amortization is now 25 years. Then yes, it may go down.
And more or less, all the financial institutions allow that increase or decrease the payment also, depending on their terms.
Okay.
TD, actually, I could increase the payment in TD, but it's not allowing me to decrease. I understand that it will not allow right now, so but I just wanted to understand the background. Thanks for that.
Right now, nobody will allow you.
Yeah, right now nobody.
Right now, no one.
Okay. Thank you, Shayan. Now we have a question from Pratap. Pratap, can you ask your question, please?
Hi, I just wanted to ask, like, do foreign assets like give you, like, help you get a higher mortgage rate in Canada, like in Ontario region, or like, can we show a fixed asset to get a more higher rate? But like the amount, like instead of saying, say 500K as a mortgage amount, can you get a higher amount approved by showing fixed asset outside of
Okay.
Canada.
Dipankar, can you answer this question, please?
Can you elaborate a little bit more, be specific a little bit more? Can you just give put an example of what is you are asking for? What do you mean by the higher interest asset or something like that? Okay.
Like, for example, if I have, say, a house in Dubai, and that has got a particular amount attached to it, say, for example, $1 million. So if with my current income and credit score, I am able to get a mortgage of, say, $1 million in Ontario currently, is it possible that showing that as a fixed asset which I have, I am approved for a higher loan amount?
Maybe possible, depending on how your Dubai property is valued with the financial institution, because not every financial institution valued every asset, fixed asset or intangible asset in the same way. Kaushik, am I right?
If you allow me to say, so basically, this is not a possibility. Straightforward, no. The reason is a mortgage is adjudicated based on your credentials in Canada. You may have any property in Dubai or anywhere in England or US, even US, because Canadian financial institutions cannot put a charge on those properties. We have our limitations. So they cannot put in, especially for the residential mortgage, commercial or big million to billion dollar enterprise, those are different things. But in a residential, small residential retail home financing, they cannot put a charge on a foreign property. And based on that, so that property is insignificant. If you sell that property, bring money to Canada, you have a higher down payment, that's a different issue. The eligibility of mortgage in Canada is based on your income, based on your credit, and your down payment. That's it.
Perfect. That's what I wanted to know. Like, is there a possibility to include that?
And if we have a property here in Canada, then that can be considered, right?
No, another property cannot be connected with another one property's mortgage.
Okay.
Mortgage to every property is individually separate.
Okay.
I have a free property. I can refinance that. I can take the money out from there for the down payment of another property.
Okay.
But that property cannot be entangled with another mortgage.
Okay. And Pratap, in your question, did you just limit your question to fixed foreign assets, or what about liquid assets? Like, let's say you have cash in, or like, let's say fixed deposits in India, let's say. So can that be considered?
In a scenario like that, the main obstacle is you may provide us the assets you have in liquid form in India, but we don't have access to all the credit business of the world. We can only access the US. So if money is lying in US banks, yes, that can be considered as a down payment amount. But if it is in India or somewhere else, because the down payment is not considerable as a down payment unless you add the liabilities that the person has in that country.
Okay.
So only US, your savings in US can be considered for down payment, not anywhere else.
Sorry, actually, Indrajit, that there will be an issue also, like if we are showing our FT or a source of income from a foreign land, then we might have to include that in our T4s. So that will again issue, and I think so. I might be wrong, but like it might act as an hindrance in the
Sorry, can you
tax
do your question one more time, please?
Sorry, it was regarding like fixed assets, like how it would be like, how I can increase my mortgage amount if I show fixed asset, but like Kaushik said, like it's not possible to do. But I do have a second part, like usually when we save money, we try to optimize our RRSP accounts to have like the tax saving going on. Will that affect or like if I fill it to my brim, whatever limit I have in my RRSP account, will that affect without pulling the money out of it as a down payment thing? Will it affect in getting a higher mortgage amount or a higher loan amount?
Maybe Devduta, can you answer that question?
I actually didn't follow. If you can repeat, please.
Sure.
Sorry.
So like when we are trying to save money, in like apart from doing investments or apart from doing in a savings account, we also try to utilize our RRSP accounts to the maximum capacity. Now, instead of pulling out the money which is already there in the RRSP account as a down payment option, can that help to get a higher mortgage or a loan amount? Showing that a full limit RRSP thing?
I don't think so. I've not seen it. You can use that as your down payment, but adding that to your asset, because you have to show what all savings you have, or whatever form, you show that as your asset. But that won't help in creating your additional eligibility. Your eligibility will solely depend on what is your earnings on that basis.
Okay.
Now,
Okay.
I will add one more thing. If you are eligible for the high net worth people or total net worth program, then that without pulling that can be used as your asset also.
Oh.
Now, Deepankar, in high net worth program or advantage, there is one more thing. I mean, you can only use high net worth to mitigate high debt servicing ratio.
Exactly. Yes.
Exactly.
There is also a limit of covering that. If the debt servicing ratio is beyond certain limit, I mean, I don't know about Scotiabank, but like for us, we can only go up to 65% if there is a really, really high net worth.
No, Kaushik, if it is a 20% down payment, we can go up to TDSR debt service ratio up to 80 or little bit beyond on that. But if it is a beyond 60 on that, 60 on that, if it is a beyond 60, we have to 35% down payment. Yes.
Okay.
Yeah, so scenario will change, like, and also it change with lender to lender. Every lender has their different program. Yeah.
Absolutely.
But basically, just to on a general sense, yes, any terms with your what is your earnings will define your eligibility. Yeah.
Perfect. Thanks.
But
it's
Kaushik, the one more thing, like I have one program which is called Straight Right, where we need the PNI 1 year PNI also. That you can show as I have the RSP 1 year PNI also. That also you can send it. There, I can TDSRs go up to 150%, 150 also.
That I don't know. If Scotia has that, then that's unique.
Yeah.
Yes.
So if I take it as a layman term, then down payment within the range of 20% to 35%, that range actually doesn't help much. So you either pay below 20%, or if you really want to get benefits, you pay above 35%. Does that make sense?
35%. Doesn't need to be above, but 35%. Yeah.
35%. Perfect. Thanks, Dada. That was really helpful. Thank you.
Okay. Now I have a question. Maybe Kaushik, you can try and answer that. In today's situation, if somebody has taken a variable mortgage, let's say in 2020 or 2021, when the rates were very low, and now the rates are so high. So let's say their mortgage has increased significantly, or the monthly payment has increased significantly. So would it be in today's situation where the rates have increased so much? So would it be recommended to go to a fixed mortgage now, or or wait because we are already at the top or near the top? So would it be recommended to wait a little bit longer?
Yes, I mean, again, this is a very controversial scenario, but apparently it looks like we are at the end of this rate hikes. So if someone can survive now, likely to go down, likely to have the rates going down further. But it's a very, the global situation, everything is integrated. We can't just separate anything. Whole thing is going in a different way. Like US is going in a different way. The war situation in Ukraine and Russia, the whole thing is in a doldrum. So it's very difficult to predict that the rate hikes have ended. Apparently, yes, based on the December the result that came up, the inflation has gone down to 6.3, which is very encouraging. So most likely we are going to have a 0.25% hike in January, and then we are going to have a pause. So based on that, the strategy that you were saying may be very useful. That well, we have already crossed the bad time. Now the rates will not go up. We can wait, and probably it's going to go down because of fixed rates. If I get into a fixed rate, I'll be fixed for next 3 years.
Yeah.
And obviously, Canadian government, the Bank of Canada has a target. They're going to bring down the inflation to 2%. And once that target is achieved, then they are going to definitely bring down the rates. They have to. So if that be the case, we are not sure when is it going to happen. But it is showing a downward trend from 8.1%. We have come down to 6.3 in last 6-7 months.
Okay.
So if this pace is going on, then probably we are going to see some rate cuts down the road. So it may be a good strategy to stick to the variable now. But if somebody gets a good rate for 2 years fixed or 3 years fixed without paying penalty, that also may not be a very bad step, because this kind of scenario will not ease down at least 2 years before. Like whole thing to go back to the previous situation probably is not going to happen less than 2 years time. And even after 2 years, it will probably not go back to a very low situation like what we had. It may be ending up somewhere around 2.5% or 3% like that.
Okay.
So anyway, but it can be a strategy that we can wait and watch for some more time.
Okay.
It may be a pause now.
Okay. Thank you. Next, I have a question from Shupriyo. Shupriyo, can you please ask your question? Maybe to Dipankar.
Yeah, so Dipankar, I have a very layman question because I still don't understand the Canadian market and I'm still relatively new here. So
At one point of time, you're all the same boat. Don't worry.
yeah, sure, thank you. Yeah, so a very layman question. It may sound stupid and dumb, but still I thought of asking you. Like in today's scenario, like somewhere down the line, if a relatively newcomer still has issues with paying your whatever the calculations you guys were sharing some time back, like within 500K you have to pay 5%, and then you have to accumulate the delta of 10% from 500K to something less than a million, right?
Yeah.
So if you are having issues with paying that entire down payment amount, okay, is there a way that the mortgage agents can, or rather the agencies can help in this regard if you suppose go ahead with your house purchase?
You can, if you are a first time home buyer, you can at least 85 or 90%. If you 100% also gift from, if anyone is going to gift you, you can get that gift down payment as a gift also. That is possible.
Okay.
So Supriya, just trying to understand your question. Are you saying that you're able to meet the criteria of the mortgage where you are eligible for the mortgage, but you're not able to meet the down payment. Is that what you're saying?
Yeah, right. So if I go by very layman terms, suppose for example, if I actually procure a house, suppose of which is which is priced at 900K, right? So going by the figures whatever was shared, I understand like I have to pay 45K as down payment, right? Now I like the house, but I don't have 45K at my disposal to actually pay the down payment. So is there any options, alternate options that are available at that point to actually go ahead and seal the deal?
Yeah, that's right. That's totally. If you are a first-time home buyer, definitely some your friend, not friend. So basically, any of your relative can borrow it, lend your, give you a gift. Sorry, not lend. Sorry, you can get the gift amount as a down. Let's say you have 5,000 and 40,000, you can get as a gift.
Oh, okay.
So,
Yeah,
so
so that gift
small
should be from
correction.
your
For
relative, means in a
900,000,
blood
it
relation,
should
they
be,
call it.
yeah, sorry to interrupt, just a small correction. For a 900,000,
yeah,
it should be 65,000.
yeah.
Yeah.
Okay.
Okay. I'm just giving a. He uttered the figure, so that's why I said 45. Just
Yeah, yeah, I think 40,000 for 500 to 900 and 25 for below 500. So that's
yeah,
comes to
65.
65. Yeah.
Absolutely 65. Yes.
Okay. Okay. Yeah, the numbers were just like I sort of.
Yeah, it's like you can get a gift from your relatives. So like whatever amount you want. So it's just showing a gift certificate that I got around 20K or 30K from my family. It has gifted me. That is absolutely okay.
In
So,
fact,
so
this
does it
is
have to be a family?
immediate family.
Yes,
Immediate
immediate
family member.
family, blood relation.
Better siblings.
Yeah.
Okay.
Okay.
In fact, this is a very common scenario. Like most of these young professionals, honestly, I have seen many. Like they're coming, they're having good income. They are eligible to qualify with a 25 years amortization for a higher amount, but the down payment is less. And remember, the down payment has to be also associated with the closing cost. So
Okay.
that
Yeah.
is something that has to be arranged.
Kaushik, just for a second. I don't need the closing cost in Scotia just to show as the developer, but you have to have it, but I don't need to show as it. Show, confirm, I think.
Okay.
Okay. Shukriyo, do you have any other questions?
No, I just wanted to get like some clarity around this thing. Thank you.
Okay, thank you. I see there's a question by Aniket. So we are right now it is 9:24. So we would like to end the session in the next 5 or 10 minutes. So if you have anybody has any questions, please post them in the chat. Right now we have one question by Aniket, and then I have one question, and these are the only two questions I have right now. If anybody wants any other answers, then please post your question in the next 1 minute. Okay, so Aniket, please go ahead and ask your question.
Yeah, I just have one question. Like, is there any risk involved if we go with a like small scale financial institution instead of like these 5 big banks? Or is there any benefit if we go
By
with
small scale, are you referring to B lender?
I'm not sure if they are B lender or not. Like, as I say, like First Nationals or other institutions which are not like these 5 big banks like CIBC, BMO, RBC, like that.
So Debduddha, can you answer that question?
Yeah, I think those are also falls under the same category of A lenders. When in a mortgage terminologies, they are all categorized in the same category as A lenders. So when you say risk involved, actually, what do you
like? Is there any problem if we go with them? Like
no, they are the one also doing same business like the other financial institution. They are also into the same business. Basically, these 5 banks are have the retail presence. Those doesn't have a retail presence. Their main
Mhm.
business is only mortgage financing.
Mhm.
So yeah, they are known as mortgage finance companies, MFC.
Okay, but there is no such risk or
No,
anything
no,
if it,
no.
or is there any benefit if we go with the like these 5 big banks?
Well, those two people from Big Five are sitting here, but well, if you ask me, I'll say yes. Or definitely I can get you a better rate. So yeah, anyhow, yeah, those
Okay.
there is no risk involved. Yeah.
Okay, okay, thank you.
Okay. Now I have a question that is most likely the last question for tonight because I don't see anybody else posting any questions. So this question is for Dipankar, and then maybe Devduta and Kaushik, you can add if you have to add anything. So this is about mortgage insurance. So what are the scenarios where mortgage insurance is needed? That is the first. And second is, will that help in any way? Will the mortgage insurance help the buyer in any way?
Absolutely, mortgage insurance help the buyer also. If any situation change anytime for any individual.
Yeah.
So if let's say you have taken a mortgage from the, let's say any big 5 bank.
Yeah.
And suppose your situation changes,
Yeah.
then mortgage insurance can help you mitigate the situation. Absolutely. Because that is their purpose. The bank will see how we can help the customer to mitigate the situation, come out of the situation. Yes, absolutely, yes.
So let's say we don't take a mortgage insurance and we take a life insurance instead, term life insurance.
Yes.
What is the difference? What is the advantage of mortgage insurance?
Mortgage insurance is your mortgage is covered and your life insurance and other disability benefit is your incidental benefit is covered. Attached, that is also attached to that also.
So okay, so in case of mortgage insurance, does it happen that let's say I lose my job and then I'm not able to pay the mortgage, so the mortgage insurance takes care of the mortgage?
If it is attached to that, obviously, yes.
No, I
Yes.
don't know what are the factors that mortgage.
There is a very fine print of the each and every insurance. You have to read what is the included on that insurance covered. It's better to ask that mortgage agent to discuss the insurance if you are at all interested in the insurance.
Basically, Indrajit, disability and job loss, these two insurance coverages with mortgage are very useful. You don't get these things from outside. So mortgage insurance for job loss and disability, suppose I'm driving, I have an accident, God forbid, anything goes wrong with me in terms of accidental things. So the insurance company pays your mortgage. It keeps paying your mortgage till you are back to normal. Or somebody has been laid off, which is very frequent in this subcontinent. And in a scenario like that, they keep paying, the insurance company keep paying your mortgage, maybe full installment or maybe partial, depending on what kind of coverage you have taken. So
Okay.
these two things generally people don't get from outside. And
Okay.
as far as life insurance is concerned, obviously there are options to go for life insurance outside as well. But when you go with the mortgage insurance, with your mortgage, basically the medical, those details are a bit less when you right away take it along with the mortgage.
Okay.
And in case of, God forbid, in case of anything goes wrong, banks really help to get these things settled very fast
Okay.
because it's their money which is stuck up.
Okay. One thing I have seen is that some people recommend, like some of my friends recommended to take a life insurance because in let's say you take life insurance or mortgage insurance for let's say a million, let's say, and let's say after 20 years, you have already paid off quite a lot of your mortgage. So let's say your property was of 1 million, and now let's say only 400K is left. Let's just say as an example. So your mortgage insurance actually covers that 400K. So you're still paying the same monthly insurance, but your mortgage, the insurance amount reduces with time. Whereas in case of life insurance, I have seen that the amount for life insurance and mortgage insurance is similar, but in case of life insurance, that amount remains the same. It doesn't go down. So that was a deciding factor for me. But what is your opinion about that? But yes, definitely mortgage insurance, like it is helpful when we have a job loss or disability. That is definitely a valid point.
Yeah, what happens is, Indrajit, when you take the mortgage, this MPP is like almost attached to that, and the person has to waive that form. You know,
Yeah.
he has to
Yes.
say that I'm waiving to that. In this category, as Kaushik also mentioned, there are different categories of how you take the mortgage protection plan. You can just take a simple plan where you will be paying, where only your mortgage will be taken care of.
Yes.
Then there is another one, your disability. You can, like there will be several columns to take. If you take the disability, then it takes care of those portion also. So
Okay.
at that moment, and the advantage at the other side is like on a term insurance, if something happens to the person who has taken that loan, his family members might get the whole amount of money of the term insurance, whatever is given. But in mortgage insurance, will be his mortgage will be paid, and whatever has been paid is paid, and the balance will be paid. So in that case, sometimes like it is a decision which a person while taking a mortgage should decide whether I should go for a term insurance or should I take the mortgage protection plan.
Okay. All right. Thank you. Okay, so those were all the questions for tonight. I don't see anybody posting any other questions, so I'm assuming nobody has any questions. We already went over the allotted time, which is good. That means, and so many people participated. So that means this session was, I'm hoping that this session was helpful. That is why people were asking questions. And hopefully our speakers were able to answer everybody's questions satisfactorily. I would like to thank Devdutta, Dipankarda, and
You are always
Kaushika
welcome.
for joining us and sharing your knowledge. And I would like to thank all the participants for joining and asking questions. Thank you all for joining this session. We will end the call now.
Thank you. Thank you, Indrajit.
Thank you.
Thank you so